Hi there and welcome to this week's edition of Maqro Minutes. I'm Mark Gardner, Head of Trading here at Maqro. I'll be running you through what happened over the last week in stocks in our universe, stocks to add to your watch list, and also the week ahead. Of course, the contents of this webinar are general advice only and do not take into account your personal circumstances and investment goals. So with the formalities out of the way, let's start with the stocks in our universe. We'll start with Service Stream, which in short had a bad week. SSM released its half-year results before the market opened on Thursday and missed all expectations. Revenue was down 17.7%, missing by 3%. NPAT was down 37.8%, missing by 15%. This was largely driven by the decrease in NBN activation volumes. They did announce a dividend of 2.5 cents per share. However, this also missed expectations by 37.5%. The company flagged significant impacts on their major revenue streams, client-initiated work reductions, project deferrals, and delays in new projects, with the impact expected to flow through into the second half of this year. The outlook is also fairly negative, with the forecast for the second half of the year expected to be approximately in line with first half results. Our research department immediately downgraded Service Stream to a sell. Thankfully, our advising team was able to get the Maqro clients out on market on open at the high at 153 before the stock dropped a further 30% over the next 2 days. So we will cease coverage on that for the time being. Now, the next one we're looking at here is C-Link. C-Link reported last Wednesday. To give you a small bit of background, C-Link's a company with core exposure to non-discretionary essential services. Overall, C-Link announced strong results with revenue up 329% NPAT. NPAT up 230%, and EBIT up 265%, driven by domestic tourism operations. They increased their interim dividend to 7% per share fully franked, and 91% of C-Link's revenue going forward is fully contracted and expected to be stable, and the company has a significant liquidity buffer of $216 million to cover any future challenges if they arise. Management did point out there's likely to be some merger and acquisition activity in the future. Maqro recommended this stock back in early November. It did hit our price target on the 24th as the market responded favourably to the strong earnings report. Next one we have up is Healius. So Healius, formerly known as Primary Healthcare, it also reported on the 24th. Overall, beat all expectations across every division. Healius was boosted by COVID testing volumes in their pathology division, while the outlook for day hospitals, day surgery, and diagnostic divisions will likely be strong as the economy opens up. Revenue was up 22%, which was in line with expectations, and NPAT was up 80%, which beat expectations by a whopping 50%. They increased their dividend to 6.5 cents per share, which was better than expectations by 61%. This reflected a revised policy of 50 to 70% sustainable payout ratio going forward. Unfortunately, there was no forward guidance, but given the Jan and Feb 21 performance across all divisions, we expect this growth to continue. Healius also announced a $200 million share buyback over the rest of the calendar year, and their strong balance sheet will provide flexibility for strategic merger and acquisition opportunities. So now we're moving on to stocks to watch out for over the next week. We're going to start with Rio. Now Rio will go ex-divvy tomorrow, paying out a dividend of $5.17 per share, including a special dividend of $1.20 per share. This translates to a 6% fully franked dividend in one single payment and reflects a 72% full year payout ratio. Recently, the Maqro Research Department increased the price target from 134 to 145 due to expectations of stimulus-led infrastructure investments around the world and increasing commodity prices. Additionally, recent fears of rising inflation, indicated by the rise in bond yields, should see the materials sector as a good hedge going forward. Next one we have up is Smart Group, SIQ. It will go ex-divvy on the 8th of this month, paying a 32 cent dividend, including a special dividend of 14.5 cents. This translates to a 7% franked dividend in a single payment. The size of the dividend, the size of the dividend indicates management's confidence in its outlook, given the revenue did decline by a meagre 13%. SIQ is well positioned for 2021 with new health clients to be onboarded in Q2, as well as a really impressive 100% hit rate of renewing key expiring clients. The company holds a solid economic moat with their strong balance sheet. In the last financial year, they reduced their borrowings from 60 million to just under 25 million. This produced a significant cost saving of $4 million. And as a result of this restructure, this is expected to continue, boosting the operating margin to 35%. Next one we have up is an upcoming IPO. So this IPO for My Food Bag is on the 5th of March. The company was founded in 2013. It's a New Zealand-based meal kit provider. It has a $448 million New Zealand dollar market cap. They're expecting to raise $319 million at $1.85 a share, 16.7 times forward EBITDA. Revenue in 2020 of New Zealand dollars 153 million. Expected to grow to 189 million New Zealand dollars in financial year 2021. 16.3 million in earnings for 2020, forecasted to be 8.5 by the end of financial year 2021. Waterman Private Capital has a 70% stake currently, but it will reduce its stake down to 15%, diversifying the shareholder concentration. The product offering will include e-commerce meal kit brands at a premium and bargain price points, weight loss offering and ready-made meals, significant market penetration with 88% of New Zealanders knowing the brand. Future growth potential is the brand name capitalisation and moving into grocery markets. Significant competitors are HelloFresh, Marley Spoon and New Foods. We only see the risks as a lack of international exposure versus their peers in this sector. So looking ahead, we'll to the next week. Basically, we're looking at China's going to release their 5-year plan this Friday, the 5th of March. The 5-year plan is expected to give it a mandate which demands greater use of scrap steel, reducing iron required, as well as stricter pollution controls, which is expected to cause iron ore imports to plateau. In addition of this potential carbon emissions cap comes as government aims to peak CO2 emissions by 2030 and become carbon neutral by 2060. Furthermore, given the trade tensions between Australia and the US in recent years, reducing iron ore imports reduces China's reliance on foreign production cycles and more on internal circulation to fuel its growth while it transitions towards a services and consumption economy with a particular focus on tech stocks. So we're also looking at this Friday the non-farm payroll statistics coming out of the US, the labour statistics. They released this report Saturday morning at 12:30 a.m. It basically gives the stats for the unemployment situation in the month of February. In January, the unemployment rate fell by 0.4 to 6.3, while significantly lower than April 2020 levels. It's still nearly double pre-pandemic levels. With the US in the top 3 countries in terms of vaccines administered per 100 people, the unemployment rate is expected to continue trending downwards to 5.3 towards the end of this year. Thank you all for listening to the Maqro Minutes, and we'll speak next week.